Hi, this is Nick Radge, manager of the Harbourside Multi-Strategy, and today we'll talk about the performance results for April 2024. For the month of April, the Harbourside Multi-Strategy returned minus 3.44% versus our benchmark, which is the Russell 1000 Total Return Index, which returned minus 4.3%. Year to date, the program is up just a little over 14% versus our benchmark of a little over 5.5%. And since its inception in January 2017, the strategy has delivered an annualised return of 19.62%, and that's a cumulative return of 266% versus the benchmark at 150.72%. So the key highlights for the month of April. Finally, we had a pause, and following 5 consecutive months of positive performance, especially in the US market, and a strong gain over there of about 27%, we did have eventually the anticipated downturn. We had been expecting that in February and then again in March, and it just goes to show there's no point attempting to predict this kind of stuff. It'll happen when it happens. So this shift in momentum really occurred as investors adjusted their expectations regarding rate cuts, and some could argue that this adjustment may have swung the pendulum a little too far in the opposite direction, because basically they've moved from an anticipated 7 rate cuts to just 1. However, the narrative of a soft landing remains intact. In the Australian market, the small ordinaries declined about 3.1% for April, and it remains just above its multi-year range that was breached on the upside in February, and this is a very positive sign. A retest of such breakouts are common, and we deem them quite healthy from a technical standpoint, and one could argue that these little pullbacks are designed to test the fortitude of the bulls or shake the confidence of any weaker hands out there. Going into May, our strategy will remain fully invested both in the Australian market and in the US market. Now, talking of May, we tend to hear the media narrative of the old adage, sell in May and go away, which implies that the subsequent 6 months represent a very unfavourable period from investment. However, when we look at the historical data, that shows that this is not really consistently accurate. To give you an example, 8 out of the last 10 years in this so-called worst 6 months have actually been quite positive. It's also noteworthy that in election years, so we've got a US election this year, we frequently see a summer rally with strength observed during May and all the way through to October, and that occurs about 78% of the time. So the chart that I have here for you shows what a standard buy and hold would look like when you buy and hold throughout the whole year, and that's the grey line, and what your equity growth would look like should you sell in May and go away. So you can see there is a considerable difference, and up until 2020, one could argue that the volatility of selling in May and going away was reasonably good, but you were eventually, is always going to be the case, caught out. So there's not a big argument for selling in May and going away. It's all about just enjoying the ride. Yes, there's a bumpy road to outperformance, but that's the way investing goes. So our investment strategies, the multi-strategy, remains completely independent of these seasonal biases or any speculative commentary. So our momentum indicators continue to be favourable, and we, as I said, maintain a fully invested position across both our US and ASX portfolios throughout May. As usual, if you've got any questions, feel free to drop me an email. I'll be happy to personally answer them, nick@thechartist.com.au. Thank you very much.